Good morning. Welcome to Kenya News Update today. I'm your host, and we begin with a critical weather alert that has put 22 counties across the nation on high alert. The Kenya Meteorological Department, Kenya Met, has issued a 4-day heavy rainfall advisory, warning of intensified downpours expected from Friday, February 20th, through Monday, February 24th, 2026. This isn't just a passing shower. We're talking about potential flooding, infrastructure damage, and significant disruption to daily life and agriculture. The advisory comes as Kenya, like much of East Africa, navigates increasingly volatile weather patterns. But this story is about more than just rain. It's about national preparedness, economic resilience, and the complex interplay between climate, governance, and global affairs. Today, we take a deep dive into what this advisory means for the affected regions, the government's response, and the broader context of a nation facing multiple pressures. We'll examine the data, speak to the perspectives, and analyze the potential fallout. This is a 12-minute special report. First, let's break down the advisory itself. Kenya Met's statement, released on Friday morning, specifically warns of heavy rainfall exceeding 50 millimeters per day in several regions. The 22 counties span multiple zones. In the highlands west of the Rift Valley, we're looking at Kisii, Nyamira, Nandi, Kericho, Bomet, Kakamega, Vihiga, Bungoma, and Trans-Nzoia. Over in the Lake Victoria Basin, Siaya, Kisumu, Homa Bay, and Migori are on alert. The Central Highlands, including Nairobi, Nyandarua, Nairi, Kirinyaga, Murang'a, Kiambu, Meru, and Embu, are also expected to be hit. Finally, the southeastern lowlands, specifically Taita Taveta, round out the list. That's a significant portion of the country's agricultural heartland and urban centers. The department has cautioned that this could lead to flash floods in low-lying areas, landslides on steep slopes, and reduced visibility on roads. Riverine flooding is also a major concern, with water levels in several major river systems already elevated from previous rains. The immediate directive from the government, through the National Disaster Operations Center, NDOC, is for residents in these areas to exercise extreme caution, avoid driving through or walking in moving water, and to relocate from flood-prone zones. But the question on everyone's mind is Kenya ready? Let's look at the capacity. According to data from the National Treasury's Emergency Fund allocation, for the fiscal year 2025-2026, the budget for disaster response and mitigation stands at approximately 2.5 billion shillings. However, reports from the Auditor General for the previous year indicate that only about 65% of allocated disaster funds were actually utilized, with the rest either reallocated or delayed in disbursement. Furthermore, the NDOC currently has 120 personnel on standby for rapid deployment across the country, supported by county-level disaster units. But with 22 counties on alert, that averages to just over 5 personnel per county, a number that seems starkly inadequate when facing widespread flooding. We've obtained internal briefing documents that suggest the ideal rapid response team for a county-level flood event should be at least 25 personnel, including logistics, medical, and engineering experts. This points to a potential preparedness gap. To visualize this, let's look at the numbers. Now, let's consider the economic impact. The agricultural sector, which contributes about 22% to Kenya's GDP, is directly in the crosshairs. The counties under advisory are major producers of tea, coffee, maize, and horticulture. Unseasonably heavy rain during this period can devastate crops. For instance, in Kericho and Nandi, tea farmers are reporting that excessive rainfall can reduce the quality of tea leaves and hamper harvesting, potentially leading to losses estimated by the Kenya Tea Development Agency at up to 300 million shillings per week of severe disruption. For maize farmers in Trans-Nzoia, the nation's breadbasket, waterlogged fields could delay planting for the long rain season, affecting national food security projections. The Kenya National Highways Authority has also flagged 15 major highways and 37 county roads that are historically vulnerable to washouts during heavy rains. The cost of emergency repairs for these roads in a single severe weather event last year was over 500 million shillings. This is a direct hit to the Treasury. But this weather event isn't happening in a vacuum. It intersects with a much larger and more contentious national conversation, the state of Kenya's economy and its strategic assets. This brings us to a parallel and heated debate currently dominating economic circles. In recent months, the government of President William Ruto has advanced a policy of divesting from state-owned enterprises, a move framed as necessary for fiscal consolidation and attracting investment. The most prominent examples are the planned partial sale of stakes in telecom giant Safaricom and NCBA Bank. Proponents argue that these sales will inject much-needed capital into the national coffers, help pay down the substantial public debt, which stands at over 10.2 trillion shillings, and improve corporate governance. They point to the successful initial public offering, IPO, of earlier entities as proof of concept. However, critics have labeled this strategy as Kenya for sale, accusing the government of auctioning off the family's silver to meet short-term obligations. They argue that revenues from such strategic assets should be long-term, not one-off windfalls, and that losing controlling stakes could compromise national interests. This debate is crucial context because it directly impacts the resources available for crises like the one we're facing. If the government is cash-strapped, prioritizing debt repayment over infrastructure resilience, then every flood, every landslide becomes more costly and more dangerous. The 2 billion shillings that might be raised from an asset sale could alternatively fund a comprehensive national flood control system. It's a trade-off happening in real time. Let's examine the for sale argument more closely. The government's rationale is built on specific numbers. The budget deficit for the current year is projected at 720 billion shillings. Debt servicing consumes over 60% of tax revenue. Selling a 5% stake in Safaricom, for example, could reportedly raise between 40 and 50 billion shillings. That's a significant figure. Proponents say this isn't about desperation but smart asset management, freeing capital tied in mature businesses to invest in new growth areas like technology and green energy. They also argue it deepens the Nairobi Securities Exchange. The chart we're showing now illustrates the performance of previous major IPOs in Kenya, showing mixed results but overall growth in market capitalization. However, opponents counter with different numbers. They cite a report from the Parliamentary Budget Office, estimating that the annual dividend payout from just Safaricom to the government has averaged 12 billion shillings over the past 5 years. Selling a stake, they argue, sacrifices this perpetual revenue stream for a single payment. They also question the timing, suggesting a fire sale when asset valuations might be depressed due to global economic uncertainty. This is a fundamental ideological split, short-term fiscal relief versus long-term sovereign ownership. And as the rains begin to fall, the consequences of these fiscal choices become tangible in the form of muddy water rushing into homes and across farms. Shifting our gaze beyond Kenya's borders, the global context adds another layer of complexity. While Kenya grapples with floods and economic policy, the world's attention is fractured. Two major international stories reveal a global system struggling with multiple crises. First, in Sudan, the situation in El Fasher has reached a catastrophic tipping point. A recent United Nations report details what it calls the hallmarks of genocide, with mass killings and systematic violence. The report is a damning indictment of international inaction, stating the atrocities were entirely predictable. Western governments are accused of prioritizing elite political bargains over civilian protection. This failure has direct implications for regional stability in East Africa, potentially driving more refugees towards Kenya's already strained borders. Second, in Europe, Slovak Prime Minister Robert Fico has threatened to cut emergency power supplies to Ukraine over an oil transit dispute, as reported by Politico. This highlights how geopolitical tensions can disrupt essential humanitarian and energy support even in active war zones. Meanwhile, in the Middle East, the founder of U.S. defense tech giant Anduril secretly visited Israel to meet with Prime Minister Netanyahu, as reported by Haaretz, signaling continued high-level defense collaboration. These stories matter to Kenya because they show a world where major powers are preoccupied, humanitarian crises are met with paralysis, and strategic partnerships are conducted in shadow. In such a world, Kenya cannot rely on a massive influx of international disaster aid if these floods become catastrophic. The response must be primarily domestic, which circles back to the strength of our own institutions and treasury. So, where does this leave us as the first drops of this forecasted downpour begin to hit? We have a precise meteorological warning covering nearly half of Kenya's counties. We have a disaster response apparatus that appears under-resourced relative to the scale of the threat. We have an economy walking a tightrope between divestment and debt, a debate that determines how much money is available for resilience. And we have a world distracted by other emergencies. The test for the Ruto administration in the coming 96 hours will be execution. Can the NDOC coordinate effectively with county governments? Will the early warning systems reach the last mile farmer in Kakamega or the informal settlement dweller in Nairobi? The metrics of success or failure will be clear: the number of displaced persons, the acreage of crops destroyed, the length of roads rendered impassable, and ultimately the loss of life. Past events have shown that Kenya's spirit of Harambee, of pulling together, often shines brightest during disasters. Community-based organizations and volunteers will undoubtedly step up. But systemic resilience requires more than volunteerism. It requires investment, planning, and the political will to prioritize long-term climate adaptation over short-term fiscal fixes. In conclusion, the 4-day heavy rainfall advisory is more than a weather report. It is a stress test for Kenya's governance, a real-time audit of its economic priorities, and a reminder of our vulnerability in an unstable world. The rains will fall. The rivers will swell. The question is whether Kenya will be swept along by events or will have built the levees, both physical and fiscal, to withstand them. The next 4 days will provide some answers. For Kenya News Update today, this has been a special deep dive report. We'll continue to monitor the situation across all 22 counties. Stay safe, stay informed, and make sure you have an emergency plan. Subscribe to Kenya News Update today for continuing coverage.